Look, if you're investing in the US stock market right now, you already know that technology is the ultimate growth engine. But as we move deeper into 2026, the whisper networks on Wall Street are getting louder about a potential AI bubble burst. Everyone is scared of a massive valuation correction, and if you are holding a major tech ETF, you need to know exactly where your money is sitting. The two absolute giants in this space are XLK, the technology Select Sector SPDR Fund, and VGT, the Vanguard Information Technology ETF. At first glance, they look exactly the same, but under the hood, their structural differences are massive, and one of them is hiding a brutal concentration trap. Let's look at the actual data. XLK is built on a highly concentrated top-heavy framework. Because of the way its indexing rules select companies, it puts a massive amount of its weight into just the top 3 tech monopolies: Microsoft, Apple, and Nvidia. If those top 3 giants experience an enterprise AI spend cooling cycle, XLK is going to take a direct, brutal hit. If you want true financial freedom without waking up to a 30% drop in your tech portfolio overnight, you have to look deeper into the architecture of your funds. Let's break down the friction between these two models. To understand which technology fund survives a massive market panic, we have to look at how they capture the broader market cap. While XLK doubles down on the mega-cap monopolies, VGT takes a completely different path. VGT tracking parameters are much broader. It holds over 300 different technology stocks, including medium and small-cap tech enterprises that XLK completely ignores. This means VGT gives you massive exposure to the entire technology ecosystem, from software as a service providers to semiconductor infrastructure companies. But here is the friction: because VGT includes all those medium-sized companies, it naturally carries a higher overall beta market volatility during normal conditions. Medium companies swing much harder than massive monopolies. However, if the AI bubble actually bursts and the megacaps collapse under their insane valuations, VGT's broader diversification operates as a structural shield. Your risk is spread across hundreds of balance sheets instead of being completely chained to just 3 corporate heavyweights. Let's break down the exact mathematical framework of how these components split during a crisis. If we look at absolute global pricing power, XLK's strategy is to rely entirely on businesses that have massive cash reserves and the ability to increase prices faster than inflation. Even in a bubble burst, companies with billions in free cash flow don't go bankrupt. They just experience a temporary valuation correction. XLK bets everything on the survival of the absolute biggest sharks in the ocean. VGT, on the other hand, insulates your core engine by ensuring that no single company can completely take down your entire investment. If a massive tech giant drops by 40%, VGT's weight in that specific stock is lower compared to XLK, which buffers the downside movement. The trade-off is clear: XLK gives you extreme concentration in global monopolies, while VGT gives you a diversified tech network. If you are tracking the data, choosing between these two depends entirely on which structural layer you trust to defend your capital baseline. So, what is the ultimate operational law to survive this potential tech correction? If you are on an aggressive wealth path and want maximum AI momentum, a concentrated allocation like XLK wins during a vertical bull run because it pumps all rewards into the top leaders. But if you are building a defensive framework to protect your principal baseline from a bubble pop, shifting toward a broader cap-weighted distribution like VGT provides superior downside insulation. The absolute secret to managing this risk is our semester rebalancing law, executed exactly twice a year. When tech stocks enter an irrational vertical run, you must systematically sweep a portion of those paper growth profits and roll them straight into your stable income or cash flow layers. Review the institutional risk disclosure on screen and in the description box before making any active portfolio moves. If you want to protect your wealth with clean, data-driven strategies, hit that subscribe button right now. Stay disciplined, track the architecture, and protect your capital baseline.